Good afternoon, and thank you for joining us again on our tax webcast. We are very excited as we have a record registration which clearly demonstrates that the Puerto Rico tax incentives continues to be a hot topic. This is our presentation slide. In addition to the ugly picture that you see there, there's some important contact information. Write down, obviously, the website address of our firm, where you can find value information, including some business guides that we are going to present you at the end of the presentation. Also, all of our routine alerts that you receive over the emails are archived in our website. So if you want to revisit them again, please go there. In addition to that, you have our contact information, email, telephones, etc. I'll be hosting this webcast for the next 45 to 50 minutes. So here we go. This is some general housekeeping. For those having trouble with the audio connection, this is the phone number, 1-800-851-3547, and the access code is 7961540. Everyone in the line is muted by default, so in case you need to ask questions, and we hope you do, please use the chat window in the bottom of the left corner that you see here, there. Please write down your name and email address. If we have time, we'll get back to you during the webcast. Otherwise, after the webcast, we also get back to you. Also, I encourage that anyone that wants to receive a copy of this presentation, please send us an email, and we'll forward you a copy of the presentation. This webcast is also being recorded, so we will then, after the webcast, follow and send additional information to see how you can revisit and see again the webcast. This is the agenda that we have for today. We already went through the presentation. Actually, I forgot to say my name. My name is Francisco Luis. I'm a tax partner at the firm. I have over 25 years of experience. And we cannot discuss the tax incentives without providing a brief background on PROMESA, because that's basically some of the questions that everybody has, whether what's going to happen with the Puerto Rico tax incentives in light of the changes that PROMESA will have in Puerto Rico. We're going to have some slides to discuss what specifically PROMESA provides on the tax abatement or tax incentives. Then after that, we'll provide what's the general framework of the taxation in Puerto Rico for corporate businesses. We have had significant changes in the last 3 years, so we're going to discuss what's the general scenario that we have in Puerto Rico without the incentive structure. In addition, before we go to the changes on the incentives, we're going to provide, without getting too technical, a general framework also of the technical issues of the federal tax implications when we have U.S. residents with ownership in the Puerto Rico entities that have incentives. Then we'll have a slide discussing what are basically the main industries that we have incentives in Puerto Rico. And after that, we're going to have basically the major changes that we have had in the last 18 months with respect to Act 20, the incentives for the export of services, Act 22, which is the act that provides tax incentives for the new Puerto Rico residents, Act 73, which is commonly known as the incentives for the manufacturer, but certainly covers more than that, and Act 74, which has had significant changes in the last few months with respect to tourism activities. And then we'll have some comments regarding the firms and the business and incentive guides that I mentioned in the slide before. So what happened with PROMESA? PROMESA was signed into law by President Obama on June 30, 2016. This original project was presented in April. It suffered various changes, and it became law on June 30, 2016, and was in effect by the 1st of July. In essence, PROMESA creates a structure to exercise federal oversight over the fiscal affairs of Puerto Rico. establishes, as you all know, an oversight board with plenary authority over Puerto Rico's financial, budgetary, and legislative process. It has powers that goes beyond those of the governor in Puerto Rico. It provides relief from creditor lawsuits through the enactment of a temporary stay on litigation similar to the one that we would have had if we were allowed to go under the Bankruptcy Act. So at the moment, there's a temporary stay with respect to those litigations. Going specifically with respect to the board, we want to address what are the main responsibilities of the board. The board main purpose is to provide the methods to Puerto Rico to achieve fiscal responsibility and access to capital markets. It's no secret that in the last 3 years we have lost this access to the capital markets, and obviously the fiscal scenario is precarious at this moment. And basically the main purpose of the board is to get back on track on those two main items. And one of the main methods that the board has to achieve these objectives is through the enforcement of balanced budget and the development and certification of a fiscal plan. Let's go to the plan itself. The plan should cover at least 5 years, and it's going to be initially presented and prepared by the governor of Puerto Rico. The governor of Puerto Rico will present this fiscal year to the board, and the board will review, and well, if it meets certain requirements, it will approve an issue that is certified, that fiscal plan. What will happen if the board doesn't approve the fiscal plan? It will provide a second chance to the governor to address the discrepancies with respect to the requirements, and in the event of a second default by the governor to provide a valid fiscal plan under the parameters and the requirements of PROMESA, the board will issue then the fiscal plan. So we have that basically the governor has the opportunity and the accountability and the ownership to provide a fiscal plan meeting certain requirements that will meet the PROMESA standards. And these requirements are specifically addressed on Section 201, subsection B of PROMESA. And on this next slide, we have the 14 requirements. And I'm going to read them all to you. And while I read them, keep in mind what will be the role of the Incentives Act under these requirements. The first requirement of the fiscal plan is that it needs to provide estimates of revenues and expenditures. It needs to ensure the funding of essential public services, provide adequate funding for public pension. It needs to provide for the elimination of structural deficits. This is no surprise. Provide for a debt burden that is sustainable. Improve fiscal governance, accountability, and internal controls. Enable the achievement of fiscal targets. Create independent forecasts of revenues for the period covered by the fiscal plan. Include a debt substantiability analysis. And the next one is very important, and think about again about the tax incentives. Provide for capital expenditures and investments necessary to promote economic growth. Adopt appropriate recommendations submitted by the board. Include additional information as the board deems necessary. Ensure that assets, funds, or resources that are on loan to, transferred to, or otherwise used to the benefit of another territorial instrumentality unless permitted. And this last one is also very important. Respect and love the lawful priorities of the lawful liens with respect to the territorial instrumentality. As you know, on August 30th, President Obama appointed the members of the boards. Probably you have heard their names. We have the 7 members of the board here. The first member of the board is Andrew Biggs. Mr. Biggs is a resident scholar at the American Enterprise Institute in Washington, D.C. since 2008. Mr. Jose Carrion, who is president and principal partner of Hope International CLC since 2012, when that entity acquired the independent insurance brokerage firm in Puerto Rico of Carrión Lafitte Casella, which was co-founded by Mr. Carrión. Mr. Carlos Garcia, since 2013, is the CEO of Bay Boston Managers and the managing partner of Bay Boston Capital LP. Mr. Carlos Garcia is also a former president of the GDB Bank in Puerto Rico, the Governmental Development Bank in Puerto Rico, under the Fortuño administration from years 2009 to 2011. This was under the PNP party administration. In addition, we have Arthur Gonzalez, which since his retirement as Chief Judge of the United States Bankruptcy Court for the Southern District of New York, has been a senior fellow at the New York University School of Law. Mr. Jose Ramon Gonzalez, who is the CEO and president of the Federal Home Loan Bank of New York since 2014, where he also served as executive vice president and COO. Mr. Jose Ramon Gonzalez is also a former president of the Government Development Bank under the Hernandez Colon administration from years from the 86 to 89. This was under the PPD administration party. So we have two former presidents under each of the main political parties in Puerto Rico. We also have as a member Ana Mato Santos, who is currently the president of Mato Santos Consulting, which is a financial service firm, consulting firm, and Mr. David Skill, who is a professor of corporate law at Samuel Arch at the University of Pennsylvania Law School since 2004. And what specifically PROMESA mentions about the tax abatement, and I wanted to provide here the exact quote of Section 208, which provides certain required reports that the governor needs to provide. And in essence says that within 6 months of the establishment of the board, which as I mentioned was October the 30th, the governor shall submit a report to the oversight board documenting all existing discretionary tax abatement or similar tax relief agreements to which the territorial government has provided. Is a party. So, in essence, the governor needs to provide this list of all the tax abatement, including the tax incentives. And this next paragraph is very important because it says that nothing in this act shall be interpreted to limit the power of the territorial government or any territorial instrumentality to execute or modify discretionary tax abatements or similar tax relief agreements, or to enforce compliance with the terms and conditions of any discretionary tax abatement or similar tax relief agreement to which the territorial government or any territorial instrumentality is a party. So there's an express recognition that the government of Puerto Rico and its instrumentalities has the authority to enter in this agreement. Obviously, they will see what's the list of the businesses that have incentives in Puerto Rico, but there's not necessarily there has to be an action with that when we have seen that one of the main requirements is that of the fiscal plan is that it needs to provide for economic growth. And certainly the tax incentives is a tool that could help the economic growth. So there's some uncertainty. Obviously, we haven't seen the board in action. We haven't seen PROMESA in action, and we don't know what's going to be the final outcome. The PROMESA provides great authority to the board, but PROMESA also recognizes the value and the authority of the government of Puerto Rico to enter into these incentives agreements. So, with this framework or background of PROMESA, we're going to go deep into the discussion. First, I wanted to have this slide summarizing what's the current scenario for the general taxation of corporations here in Puerto Rico. Basically, we have a gradual tax rate that starts from 20% up to 39% for the adjusted net income. Dividends are now being taxed at the rate of 15%, and the long-term capital gains of corporations are taxed at the rate of 20%. In addition to that, we have three taxes on the municipal arena, which is basically the municipal tax on volume of business, which is commonly known as the patente. It's like a gross receipt tax, which basically every municipality in Puerto Rico impose, and it has the authority to impose this tax from a rate structure from 0.20% up to 0.5%. Basically, most of the municipality are at the higher tax rate of the 0.5%. In addition to that, property taxes on its personal or real property are also subject to tax here in Puerto Rico. We have different rates according to the municipalities. In the case of personal property, it varies approximately from 6% to 10%, and in the case of real property, it varies from 8% almost to 11%. And as you know, in the case of real property, there is a back value up to the values of the real appraisals up to 1952. So basically, you have to discount the fair market value up to 1952 and apply these high tax rates. Before going into the incentives, I wanted to have some discussion also on the federal tax issues. When we have structures combining the Puerto Rico incentives on the Puerto Rico corporations, but with U.S. residents as part of the ownership structure. And these are basically the main questions that we're going to address. In essence, what is a control for a corporation? What is the super income, etc.? Let's go into the discussion. What is a control foreign corporation? Basically, when we have more than 50% of the foreign corporation owned by a U.S. shareholder, we have a control foreign corporation, a CFC. And this test is if this happens at any time during the taxable year. And keep in mind that even though Puerto Rico is a U.S. territory, the corporations created in Puerto Rico are considered foreign corporations in the eyes of the U.S. Code. So basically, if we have U.S. shareholders that have more than 50% of the ownership of a Puerto Rico corporation, we have a CFC. So the next question will be, what is a U.S. shareholder? And the U.S. shareholder is a U.S. person that owns more than 10% of the voting power of the entity. So if we have, for example, an ownership structure with 11 U.S. persons with equal shares, none of them will have more than 10%, and even though it's 100% possessed by U.S. persons, we don't have a CFC. So first, again, we have to have more than 50% owned by U.S. shareholders. Those U.S. shareholders are the U.S. person that have more than 10%. And there is an important exception to the U.S. person definition, and it's that it excludes from that definition the bona fide resident of the U.S. possession. So if you have a bona fide resident of Puerto Rico in the ownership structure of an entity, that person does not qualify as a U.S. person. So, for example, if we have more than 50% owned by Puerto Rico bona fide residents, we exclude the treatment of the CFC for the entity, even though we have 49% owned by U.S. shareholders, and it could be even one shareholder that have more than 10%, but to the extent that we have a Puerto Rico bona fide resident with more than 50%, there's no CFC. But what happens if we have a CFC? That not necessarily plays an issue. We will have an issue if we will have had subpart income, and this is the second component that we have to evaluate. And in the case, for example, of Act 20 entities which provide services, there are certain characteristics of the subpart income that we have to see, and one of them is the one that I am highlighting right now, which is the foreign-based company service income. I'm going to go back into that in the next slide, but keep in mind that there are certain types of service income that may trigger the subpart income. What happens if we have subpart income? The issue with the subpart income is that the U.S. shareholder avoids the federal status that we'll have achieved by having an ownership in a foreign corporation. It basically has to pick up the income of the entity that is attributable to his ownership in the corporation and tax that at the federal tax level, even without any distributions. Now, the foreign-based company service income, which is the type of subpart income that would trigger under, for example, an Act 20 entity, basically what we need to keep in mind here, and I don't want to get too technical here, is basically the Puerto Rico entity needs to act without receiving substantial assistance from a related party in the U.S. For example, if we have a U.S. resident that creates a Puerto Rico entity and have 100% of that entity, we have a CFC. But do we have a subpart income? Well, if that entity in Puerto Rico acts standalone by having its functions being provided by the Puerto Rico employees, and he basically is a chairman of the board, he monitors the operation but doesn't take part of the day-to-day operation, there's no issue with that. But in the case that the U.S. resident is basically controlling and providing all the assistance to the Puerto Rico entity or a related entity to, for example, to whom the Puerto Rico entity is providing services in the U.S., is basically providing the services to the Puerto Rico entity, then we will have the subpart income. And it is very important to keep in mind this notice, the notice 2007-13, which basically provides some guidance, and it also provides specific changes to the substantial assistance determination. Basically, it says that if the Puerto Rico entity is subcontracting more than 80% of its cost with a U.S. related entity, meaning the shareholder or another related entity, it basically is having substantial assistance from the U.S., and that will trigger the subpart income. So I wanted to provide this background with respect to the federal tax issues, because we see on the structures that we may have U.S. residents as part of the ownership structure. There's no issue with that. We have to monitor first if we have a CFC for the U.S. resident, and if we do, if that entity is having subpart income or not. And again, we will have the subpart income if we have the Puerto Rico entity if we have the scenario that the Puerto Rico entity is receiving substantial assistance from the U.S. related entities. If we don't have that scenario, we don't have an issue. And basically, there's some benefits for the U.S. resident because he will have the deferred status that he's trying to achieve, and once he receives the dividends from Puerto Rico, they will be qualified dividends in the U.S., which will be taxed at the long-term capital gain. So let's go to basically what are the main industries in Puerto Rico that are having tax incentives right now. This is a slide that basically covers all the industry. As you see, we have a very diversification of industries with incentives in Puerto Rico. We have pharmaceuticals, we have agriculture, manufacturing, electronics. This is a new one, the creating industries, and there are some important changes for Act 20 entities. We have insurance, tourism, export services, etc. Okay, now we're going to go over the changes to the 4 Incentives Act that we discussed at the beginning: Act 20, Act 22, Act 73, and Act 74. We're not going to go deep into the discussion of each act because we want to go over the changes. We had a webcast last February which provided more details and more specification specifically on Act 20 and Act 22, and that's on our website if you want to revisit that again. Here we're going to focus on the changes that we have had in the last 18 months. Notwithstanding with the discussion of each act, we may have 1 or 2 slides just to provide like a brief summary of the incentive structure of each act. Act 20. Basically, as you know, it provides for a 4% maximum tax rate. It's a flat tax rate on the net income that is earned on services that are provided from Puerto Rico to outside markets. And these incentives are locked up in a tax exemption decree, which covers a period of 20 years. So for 20 years, you have the certainty that that's going to be the tax structure for the Puerto Rico entity, even though Act 20 is eliminated, is derogated, or is changes. the benefits are going to be covered and they're going to be addressed in an agreement that the entity will have with the Puerto Rico government. And these 20 years can be extended for 10 additional years. Then again, the eligible services must be rendered in connection to an activity that has no nexus in Puerto Rico, and we're going to have some discussion on this soon, because we have a new regulation that was issued to amend the prior regulation that we had that expand on the nexus discussion. And again, the services have to be provided in Puerto Rico, and the recipient of the service must be an outside Puerto Rico market. One of the changes that we have had a lot of discussion is Act 187, which was issued late in 2015. This is the act that basically provided and included in the law the employee requirement. Prior to this act, even though most of the tax exemption grants issued before this act had the three employee requirements, those were for public policy of the agency, not necessarily they were written on the law. Right now, we have this in the law. And basically, the law says that every entity that will enjoy the benefits of Act 20 needs to create at least 5 employees of Puerto Rico residents. And then after that, there was a circular letter issue, and this is public policy. This may be subject to change, and on how to achieve that 5 employees. First, you have the first 6 months after you commence the operation under the Act to have your first 3 employees, and by the end of the second year, you need to have your 5th employee. One of the questions that we have a lot is whether the owner of the entity may qualify as one of those employees. It can. Keep in mind that it has to be a Puerto Rico resident, so if the owner is outside of Puerto Rico, is a U.S. resident, it will not qualify for part of this employee, and also it will create the scenario that if that employee, meaning the owner, is providing services for the Act 20 entity outside of Puerto Rico, that will not be Puerto Rico source income and will not meet the key requirement of Act 20, that is that the service has to be provided in Puerto Rico. So, yes, the owner may qualify as one of the employees, and on this regard, Treasury issue an administrative determination that we're going to discuss in the next slide. And here we are. During 2015, the Treasury Department in Puerto Rico issued the Administrative Determination 1522, which provide guidance on the imputation of wages. Basically, what says that if the Secretary of Treasury intervenes with an Act 20 entity, and there's the figure of the officer owner, and under the eyes of the Puerto Rico Treasury, there is no adequate compensation for that officer owner for the services that he is providing to the Puerto Rico entity, he may impose a reasonable compensation up to $350,000. So this is not necessarily means that this is the type of the amount of compensation that the officer owner needs to have, but basically says that the secretary may impose up to this amount. It's going to be a reasonability analysis, but obviously you don't want to be in the situation that you're going to leave the Secretary of Treasury to decide what's reasonable or not. So our recommendation is that basically when you have a scenario, when you have an owner of the entity that is providing services, that owner pays himself, basically the entity pays the owners what would have been the compensation that would have paid to a third party if the third-party employee will have been providing the services that the officer owner is providing. And there's a definition of what is an officer owner of the entity, and it's the one that provides no less than 80% of his time to the activities under the Act 20. These are the basic eligible activities that we have right now. In 2014, we had some amendments which provided for some additional activities. The international trading companies and the distributions were included there. And I bring this up just to keep you in mind. There are some changes with respect to one act that we're going to discuss now, with, specifically with the creative industry, which provides some relief for the base period income. Keep in mind that when you are providing services to the U.S., to a related party in the U.S., and to a related party in most of the Latin American countries, those transactions will need to be covered by a transfer pricing study. And I wanted to bring this because transfer pricing study is now a hot topic here in Puerto Rico. As you may have heard about the Walmart case, this was related to some legislation that we have in Puerto Rico since 2013 that basically, instead of having transfer pricing standards here in Puerto Rico, it basically provided for certain disallowance of expenses when they were incurred between a Puerto Rico entity and a related entity that was outside of Puerto Rico. And also it provided some charges for the introduction of personal property, like for example inventory, under this scenario of related entities. In 2015, those charges were significantly increased, and Walmart challenged that on the federal court. It won on the first instance, and the Secretary of Treasury appealed at the circuit in Boston. And in August, there was a ruling issue, a final ruling issued by the appeal court, stating that Walmart was right on his case. We issue an alert that you may see in our website, having a brief discussion on this. But the reason I bring this is because after that case, one of the orders of the appeal court was that Puerto Rico should adopt transfer pricing consideration that it already has on its regulations. And the Secretary of Treasury, after that ruling from the appeal court, said that it will not challenge anymore the case, and that it will come up with a transfer pricing regulations here in Puerto Rico. It was mentioned that probably we may have some guidance on that by October of this year. Keep in mind that in the eyes of the U.S., there are two main sections that we need to monitor for when we have transfer pricing issues. Section 482, which is the one that requires that the standard that the transaction needs to be under arm's length, and Section 6662, which is the one that provides for the penalties if we don't have these transfer pricing studies. This is something that, even though the transaction at the end may be reasonable and may be arm's length, if you don't have the transfer pricing study at the moment when the IRS visits, the penalty is imposed. So you cannot wait until the visit of the IRS to have your transfer pricing study. You need to have this before. The new regulation that I mentioned before with respect to the expansion of the nexus concept, it provides an interesting scenario. Basically, it says that, as you know, the key requirement is that you need to provide the services from Puerto Rico to an outside market. And it says that the services can be provided to an entity that has an office or fixed place of business in Puerto Rico, directly or through a subsidiary, at the time the services are being rendered, provided that it is demonstrated with clear and convincing, and this is a quote from the regulation, clear and convincing evidence that such services have no connection or relationship to that office or fixed place of business in Puerto Rico. And it says that basically have the taxpayer, the exempt business, has the burden of proof to prove that the services have no relation to the office or the fixed place of business in Puerto Rico, because there is a presumption that the services will have that connection. In addition to that, we have had a lot of discussion on the Sirius LLC, and recently on August 4, 2016, Circular Letter 2016-001 was issued, specifically with respect to the Sirius LLCs, and basically addressed some main consideration with respect to the employment requirements. Basically it says that the Sirius LLC will be subject to the 5 employees requirement at the Sirius LLC level, at the main level, and in addition to that, for each series that the Sirius LLC issues, there will be a requirement of 3 employees for each series. So we will have the 5 employees at the main LLC, and for each additional series, it will need to create at least 3 employees. Notwithstanding, it provides the discretion that if the taxpayer or the exempt business is able to demonstrate to the satisfaction of the Secretary of the Department of Economic Development that such general rule it will be a hardship, it may get a waiver over that additional requirement of the 3 employees. Another change that we have on Act 20 is with section, with Act 130 approved this year. Basically, when we have a business in Puerto Rico that is already exporting services and is not yet requesting the benefits under the Act 20, when it goes to request the tax exemption grant and it already had an operation in Puerto Rico that was exporting services, it will have that will trigger a base period income. And basically, what it says that the benefits of the Act 20 will be on the excess of the base period income. For example, if I had an operation here in Puerto Rico and I'm basically having, let's say, a net income of $100,000 per year, and I go after 3 or 4 years of being in operations in Puerto Rico to request the benefits, they will give me the benefits of the 4% tax, but on the incremental value over the 100,000 that I was averaging as the net income under my base period income. This law basically provides a waiver of that base period income to the creative industries that request the benefits. And basically, in order to see the definition of the creative industry, you need to go to section to Act 173 of 2014, which was the one that introduced this creative industry. And basically, it covers some categories on design, arts, media, creative services, the type of activities that are being exported. As a matter of fact, I wanted to point out the issue of the base period income is quite significant for Act 20 because that base period is for the longevity of the tax run. For the 20 years, you will have that base period income. It's not like, for example, on the Act 73, the one for manufacturing, that said that the base period income elapsed during the first 3 years. It's a phase out that after the year 4, you are ready without base period. On the Act 20, there's no phase out. Now let's go to the changes on Act 22. Basically, as a background, Act 22 is the one that provides tax exemption on dividends, interest, and certain capital gains. And these benefits are, if you get a tax grant, are valid until year 2035. Basically, have a requirement from the Puerto Rico perspective is that you should not have been a resident of Puerto Rico for the 6-year period prior to the approval of Act 22, which was approved on January 17, 2012. And basically, the way this benefit works, because we continue to be U.S. residents, even though we moved to Puerto Rico, and the Puerto Rico born individuals are U.S. citizens, there's an exclusion in the U.S. Code, which says that basically, if you have a bona fide resident of Puerto Rico, that bona fide resident of Puerto Rico is able to exclude from federal taxation the Puerto Rico source of income. So basically, the Act 22 will be of benefit to the extent that you have Puerto Rico source income in the 3 categories of income that are exempt: the interest income, the dividend income, and the capital gains. Act 187 also provides changes to Act 22. Basically, it now requires that the applicant of Act 22 needs to acquire a residential property in Puerto Rico within 2 years after getting the tax grant. And he also needs to have to open a bank account here in Puerto Rico. This second requirement is kind of academic because you need to have that also for part of the closely connection test, which is the one that you need to comply for purpose of federal taxation. And specifically addressing the federal taxation issues, when we have the Puerto Rico bona fide resident, we need to make sure that we not only comply with the definition for Puerto Rico tax purposes, but also for U.S. tax purposes. And as you may have heard, and we covered this in detail in our prior webcast that I mentioned on February, there are 3 tests that the Puerto Rico bona fide resident needs to comply to make sure that he meets this standard for U.S. tax purposes: the present test, the tax home test, and the closer connection test. And the reason I bring this is because there was an important change to the regulations, and there is now a new rule that provides a window of days outside of Puerto Rico and outside of the United States that may count as Puerto Rico days. And we're going to go into that in the next slides, in the next 2 slides. This is basically the present test as we have it prior to the amendment. Basically, you have 5 alternatives to meet the present test to be considered. To meet the present test, which is one of the 3 tests that you need to comply to be considered a bona fide resident of Puerto Rico. That you have to spend in Puerto Rico more than 183 days. This is one of the alternatives. Another alternative is that in a 3-year period, you need to be in Puerto Rico 549 days and at least 60 days every year. That you can not be in the U.S. more than 90 days. Keep in mind, this is alternatives. You need to meet only one of them. The 4th alternative is that you cannot have more than $3,000 of earned income in the U.S., and you need to be present more days in Puerto Rico than in the U.S. And the 5th alternative, if you don't meet any of them, is that you cannot have a significant connection to the U.S. during the taxable year. And basically, you will meet that if you don't have a permanent home in the U.S., if you are not registered to vote in the U.S., and that your spouse or child needs to have also a resident in Puerto Rico. The change that we have with respect to the present test is that any day that the taxpayer is outside of the relevant possession, meaning Puerto Rico, and the United States is outside also of the United States for business or for pleasure, will count as Puerto Rico days. So, for example, if you are in Spain in vacations for 2 weeks, those 2 weeks will count as Puerto Rico days under this new rule. There are some important considerations. This applies for taxable years commencing after August 26, 2015. So basically, if you are on a calendar year, your first taxable year under this new rule will be taxable year 2016. And you cannot use these 30 days windows, and it doesn't have to be continuously. You may use 1 week at the beginning of the year, 1 week on summer, and 1 week at the end of the year, for example. You cannot rely on this 30-day window to meet the second alternative of the present test, which is the one that I'm highlighting right now. This is the one of the 549 days. You cannot use those 30-day windows to meet that alternative. But you can use that, for example, for the 183 days. So, for example, you could be in Puerto Rico 153 days and 30 days outside of Puerto Rico and outside of the U.S., and you will meet the standard. Just to complete the discussion, the tax home test, that is the one that you need to have in Puerto Rico, your principal place of business, and the closer connection, which is the one that provides the nine factors to document that you have a closer connection in Puerto Rico rather than with the U.S. Basically, where is your permanent home, where's your family, your personal belongings, where did you conduct your routine banking activities, etc. Now, let's go to Act 73, the one that was approved on May 28, 2008. This is commonly known as the incentives for manufacturers because manufacturers were most of the type of businesses that were conducting business in Puerto Rico under this act. But we have a slide coming soon that will provide you basically all the eligible activities. And keep in mind that for over 70 years in Puerto Rico, we have had this structure of tax incentives here. Basically, these incentives focused on manufacturers were the ones that helped transition Puerto Rico from the agricultural industry to an industrial economy. The latest act that we have is Act 73, and again, these incentives are also secure in a tax grant. In the case of Act 73, is for 15 years. These are the eligible activities that we have under Act 73. Basically, the production of manufacturing products on a commercial scale. This is the main activity. There's one activity that is very important, and this was a new concept when Act 73 was approved, and it's the key supplier. And we see many opportunities that are not being taken under this key supplier. Basically, what it says that if you are a supplier of, for example, a manufacturing entity or an entity that have an incentives under Act 73, you may also request the benefits of Act 73, even though you are not on the manufacturing business. You can be on the service industry and provide services to this exempt business, and you may request the benefits of Act 73. In addition to that, we have other important categories, like, for example, recycling activities, which have partial and total activities. We have strategic projects. We have R&D, which provides significant tax credits, as we're going to discuss now. The development of license or patent software, and we had some changes during this year on this activity. Basically, these are the main activities under Act 73. Act 30, the one that we discussed prior, that provides changes to Act 20, also brought changes to Act 73, specifically with the activity of the development of the license or patent programs. Basically, it expands the definitions and provides more guidance on when those activities are really providing value added in Puerto Rico. It specifically address that the entity may have intellectual property in Puerto Rico and be covered by the incentives. So these, when we see, for example, the combination of Act 73 and Act 20, specifically, like, for example, under the software business, that we may have the development of software that may be covered by Act 73, and the services that those development of software it may trigger on outside markets under Act 20. There's a useful combination that we may have on combining the efforts under these two acts. For example, under Act 73, there are particular tax credits that activity may generate, and under Act 20, we have the 4% tax that is also available under Act 73. Basically, this is the framework of Act 73 in terms of the incentives on taxation. It's basically similar to Act 20. It's a flat tax rate of 4%. In the case of royalties that the entity has to pay outside, basically the withholding is reduced to 12%. The standard in Puerto Rico is 29%. There is an addition that this act has that Act 20 doesn't have, and is that if you develop a business in Puerto Rico under Act 73 and you decide to sell that business, the tax on that sale of business is also a 4% tax. That's something that we don't have under Act 20, and that's why, for example, Act 20 is highly promoted with Act 22, which provides for 100% exemption on the capital gains. But keep in mind that you don't need to have both acts together to take the benefits. You may have a structure of Act 20 without 22, without Act 22, and you could also have Act 22 without the benefits of Act 20. But going back to Act 73, in addition to the 4% tax, there are certain credits. Some of them are maybe resale on the secondary market. For example, in the case that the entity in Puerto Rico purchase products that are manufactured in Puerto Rico, it may have a tax credit of 25% on the increase of that on those purchases in Puerto Rico. In the case that those products are from recycling activities, the tax credit is 35%. In addition to that, we have two important credits, which is the one for R&D. Basically, there is a 50% tax credit on the investment that the business conducts during the year in research and development. And those are the ones that you can sell on the secondary market. For example, if you spend $1 million in R&D in Puerto Rico, you may qualify that activity, and this needs to go through the Secretary of Treasury as well, and there's regulation that provide how to qualify this. And you get $500,000 in that scenario as a tax credit, which you can resell on the secondary market. Typically, those transactions are at discount from 88 to 92, 93%. So you may get a rapid return on the investment that you made on R&D. And that sale is 100% exemption. In addition to that, if you acquire a business in Puerto Rico that is under Act 73 or 185, which is the prior law to Act 73, and there are still business under that act, 50% of the investment that you made to acquire that business may also create a tax credit that you can sell on the secondary market. Act 73 provides a 90% exemption on personal and real property, 60 to 75% exemption on the volume of business tax, the patente, and 100% exemption on the indirect taxes on consumption taxes in Puerto Rico. The last act that we're going to discuss is Act 74 of July 10, 2010. This is the tax incentives for the tourism activities. Basically, in this slide, you see all the activities that may qualify under this act, hotels, condos, guest house, etc. Act 186 of 2016 provided also for two additional activities, which are basically for small activities, but we have two additional activities, which is Posadas de Puerto Rico and the bed and breakfast are also covered now specifically under Act 74 and may also get a tax grant. This is the difference on the type of the tax relief that the incentives provide for the tourism activities. Instead of having a 4% tax as Act 73 and Act 20 provides, Act 74 provides a 90% exemption. So you are under the 39% normal regime, but you have a 90% exemption. So it basically reduces the tax rate to a 3.9%. Similar to Act 73, there's 90% exemption on real and personal property. In the case of volume of business, the exemption is higher. It's between 100% and 90%. And also, there's on excise taxes and sales and use tax, there's a 100% exemption. Basically, the main changes that we saw for the tourism activities are with respect to the tax credits. And these credits are also available to resell on the secondary market. They are not subject to the moratorium that is being in place for the past 4 years. The prior rule that we have before the approval of Acts 136 and 137 is that you get a tax credit for the lesser of 50% of the investment that you made in cash or 10% of the eligible cost of the tourism project. For example, if you make a $10 million investment in the project cost, and out of that you invest $3 million in cash, basically you will go to this rule, and 50% of the investment in cash will be $1.5 million, but 10% of the eligible cost will be $1 million. So basically, your tax credit under that scenario will be $1 million. That credit, you are able to use it, you can sell on the secondary market at discount. The first change that we have under this was that if the project is an inn that is certified by the Puerto Rico Tourism Company as an ecotourism or sustainable tourism company, the credit will be, instead of 10% of the eligible cost, will be 20%, and instead of 50% of the cash will be 60%. So we have an additional advantage if the project is an ecotourism project. In addition to that, we have two alternatives to generate tax credits. First, instead of going to this rule of the 50% of the total investment, and that you have of the total investment in cash, or the 10% of the total project cost, you may elect to go over one of these two rules. First, 40% of the total credit cost, of the total project cost, which can be used in 3 equal installments, commencing on the project's second year of operation. In addition to that, the other alternative is 30% of the total project cost will be a tax credit, and you can use 10% of the credit upon obtaining the complete financing for the construction of the project, and the remaining in 3 equal installments. The first installment commencing in the year in which the project receives its first paying guest, and the second and third installments in equivalent positions during subsequent portions during subsequent years. Basically, this covers the main changes that we have on Act 20, Act 22, Act 73, and Act 74. Last May, I think, we issue or update on our business guides, the Doing Business in Puerto Rico, the Puerto Rico Tax Incentives guides. These guides, you may access these guides over our website. That's why I pointed out the website address at the beginning of the presentation. Remember, please, if you want a copy of this presentation, send us an email, and we'll send you the presentation. And also, we basically cover the complete 60 minutes that we have under the agenda. So we know that there are many questions. We're going to address them, and we're going to get back to you either by email or by telephone. So we thank you for joining us again in our webcast, and we'll keep in touch. Thank you.